scaling in can sometimes be an issue, especially if we don't know what time frames to be looking at and when we should be entering. What's up, guys? Welcome back to the channel. I am T.Mayne and welcome to another awesome YouTube video. Now, as today's title suggests, guys, we're going to be getting into scaling in, time frame thinking, and cycles. Before we get into things, guys, I would like to thank Elrich Peterson for actually requesting the scaling in topic, and this is a video obviously based off scaling in, but I figured that scaling in just has a lot more to it than just the process, and I'll give you guys the extra information and we'll mash and mix together, I guess, just the different concepts so that we can get to a nice refined process on how we can approach scaling in. Not only that, but how we can approach our general trading processes. Now, to begin, guys, we're going to speak about scaling in. Now, let's get started with a simple example. So we're going to actually go through the live market, or while it was live, we're obviously going to be looking at this in hindsight at this current point in time. So I'm going to actually be going through trades that we actually took last week, that we were actually in actual scale ins and all of that nice, good, juicy stuff. So let's get into just our general processes of scaling in. So we need to have objective rules that we follow, rules that obviously guide us and help us operate within our criteria. So the first thing that we are going to speak about is our initial entry. So we first of all looking for that initial entry in the best place, obviously at our higher time frame support or resistance structures. So we are looking initially to get in on a trade that is meant to be a swing, and what the intention is that on this swing, if we are right in the direction of the momentum, then we should be able to, or should be looking to, add positions onto this winning trade. That is scaling in. Now, after we've initially entered this market, what we'll be looking for is obviously to enter again at levels of higher time frame structure. So once we see breaks of higher time frame structure, then we look for those retests and for those continuation structures to, I guess, continue to develop. And as we're doing that, and as the market is actually playing out, what we're doing is every retest, or rather every opportunity that presents itself along the way, we look to jump into that trading opportunity and hopefully ride it further. So the general rule for scaling in, and this is basically off my personal trading plan, it's no objective rule. These are subjective based rules based off stuff that I've tested and stuff that I've found success using. So general rule of thumb for my scale in entries is that I will never scale onto a position if my scale in opportunity does not give me a risk to reward ratio of 1:3. So as much as I'm looking to take this initial trade with a risk to reward ratio of 1:3, every scale in that I take along the way should also have a minimum risk to reward ratio of 1:3. Risk to reward ratio, guys, is absolutely paramount. It's the pinnacle of good risk management, and having a system that employs or that uses a good risk reward ratio obviously is a long-term winning system. So whether it's our initial entry or it's the scale in that we're taking, we always want to have a minimum risk to reward ratio of 1:3 running on that position. Now, in addition, guys, what we'll also look to do is we'll also look to scale in at important higher time frame structural levels. So we will look for our lower time frame entries, obviously for our entry criteria to be met and for the scale in entry criteria to be met, though we always want to be scaling in, or at least be looking to scale in more often than not when we are at these higher time frame resistance and support areas. So as much as we can still be able to scale in along the way on this impulsive push to the upside, where we want to optimize and focus on putting majority of our scaling positions are at our continuing support and resistance area, or at our higher time frame support and resistance areas. So now that we've spoken about some objective rules for our scaling in, I'm going to go into time frame thinking. Now, all of this, guys, is absolutely necessary. It's absolutely important. Otherwise, I would not have put these concepts together. So please do pay attention, and please do take notes if you need to, if you're not going to remember this later, because this will absolutely crack your brain and will change the way you look at the markets forever if you understand this particular outlook and way of looking at things. So let's get into time frame thinking. Time frame thinking, we have a candlestick, one candlestick over here. We'll say that this is a weekly candlestick. Now this weekly candlestick obviously has the open, because this is a green candlestick, so we know market opened here. We obviously can see that the market pushed to the downside, created a low, pushed to the upside, created a high, and then obviously the close shows us where the candlestick closed. So going into things, we know that every candlestick basically has a high, it has a close, it has an open, and it has a low. And if this is a weekly candlestick that we are talking about, we know that in a week there are 5 days. So if we go to a daily chart, we would obviously see 5 candlesticks showing us some sort of structure that obviously coincides or links or looks like that one candlestick. And if we had went down the time frames even more, ended up maybe on a 15-minute chart, what we will see is actual structure that looks like that. Within that one weekly candlestick, we'll see a whole lot of candlesticks that create some nice looking structure. Now that is the essence of time frame thinking, understanding that there are time frames. And because there are time frames involve or imply that there are cycles. If we see a time frame or a candlestick, a weekly candlestick with an open, high, low, and a close, we understand that there is a weekly cycle that involves, or that means that the market will create in a weekly cycle an open, a low, a high, and a close. So because we are using time frame thinking, looking at the market like this and understanding that it's fractal and within a candlestick there is structure, we now know that the structure that forms on every time frame is governed by a cycle. That cycle is linked to time. The most important thing on every chart, the only two things that a chart is made up of is obviously price, the amount that price is moving or where price is ticking up or ticking down, and time, the period of time in which price is doing that particular price movement. Now going forward, guys, I'd like us to also, when I'm using this drawing tool, you can see here at the bottom it does show us the dates and all of those nice good stuff there. It's going to be necessary for this whole, or the combination, combining scaling in time frame thinking and cycles when we now look at actual live market structure, or well, not live market structure, it's hindsight, but structure, I guess, from the market. So let's look at Aussie CAD. Now on Aussie CAD, guys, this is obviously the 4-hour chart, and our 4-hour chart basically started somewhere in and around these areas, somewhere around here. So this was where our week opened. We obviously know that our week closed over here. So this is all the price action that has happened within our week. Now within that week, we obviously know that there are days, and every single day there are different sessions. Now what I would like to do is, because we understand that in a week there should be obviously a open, high, low, and close, and that we also use a nice analysis process. So we always do analysis. Just for the purpose of this video, I'm not going to be doing analysis, but I'm going to be discussing just the concepts of scaling in, time frame thinking, and cycles. So we're not going to do analysis. We're just going to go into this saying that we just automatically had a bullish bias from these higher time frame support structures over there, and that's how we'll move forward. So going into the beginning of the week, we know that we have a bullish bias on Aussie CAD. Let's actually just go down straight away onto the 3-minute chart, guys, because what I would like, I don't want to jump in between time frames very often, jumping in between 5 minute, 3 minute, whatever, because it's going to require us to wait and actually wait for the chart to load. 3 minutes is low enough to actually see the entry time frame, which I actually used, which was a 1 minute, and also to see higher time frame structure, which I was working off, which is 15-minute structure and 5-minute structure. Obviously, every time I did analysis, it was higher time frame top down analysis, and I was always trading off higher time frame structure. But let's remember the purpose of this video. So getting into things, guys, what we will see is that the week opened, let's go and find it. Okay, the week opened somewhere over here on the top over there. So what we will see is that obviously when the week opened, we were on the top, and we came into this week doing our multi-time frame analysis and established that we will have a bullish bias. So Monday came through, we saw that market was at resistance. Anyway, we let it slide. We get into Tuesday. So Tuesday opened somewhere over here. Anyway, we go through Tuesday. What do we see? We start trading at about 9 o'clock, which is somewhere over here. So guys, I want to involve this thing about time because this is my daily routine. I trade from 9 a.m. all the way until 11 p.m. So I'm only trading, I guess, pre-London session, or the pre-London hour, which starts at 9 o'clock because London opens at 10 in South Africa. So I do trade from 10, or at least I'm looking to trade London momentum and New York momentum. So I trade from 10 o'clock, so I know the time that I'm in front of the charts. So we know that on a typical day, or at least in my typical day, I'm at the market, or at least I'm starting to look at the markets from 9 a.m. So we start Tuesday off somewhere over here. I'm looking at the markets with my bullish bias. What do I see happening on Tuesday? So on Tuesday, what I see is some sort of a double top structure. I see buyers pushing prices up, sellers pushing prices down, buyers failing to push prices above the previous area where sellers came in, and I see prices violating structure to the downside. Now I have a bullish bias on this pair. What do? I wait for structure to turn into the direction that I'm looking for it to turn to. So because I have a bullish bias, I'm waiting for structure to be bullish. So what I do then, I obviously mark out my lows. This is just how I approach the market. So I mark out lows, and then I look to see how the market is treating lows. What we see here is, again, more, I guess, buy side liquidity being taken out, and then prices grabbing that and then making this move to the upside, changing structure by breaking above these smaller, lower time frame structural areas. Now I know that prices have begun, or at least on a smaller time frame, shifted into bullish bias structure. What do I do next? So later on during the day, around noon, what we see is prices breaking back within our structure, and then we see momentum of our previous structural area that prices had broken below and broken and closed back above. So what we do next is obviously we trade that momentum, putting our let's just do this. Where's that long tool? Long position. So we already know that we are not trading, or we are not looking to scalp this pair. Our intention over here is to swing. We are trading that higher time frame momentum, so structure or stop losses below important levels of structure, and I guess targets towards or close to previous target areas that we could have been looking for. So this is, I guess, let's say the full trade that we're looking to take. We're looking to take an opportunity of this kind. So we're in there, we get into our position, our long-term swing, whatever the case is. Let's just do this. We'll just do that so that it does not disturb us as we analyze the market. So that's our day on Tuesday. Anyway, day goes on. We get into, let's see, Wednesday. Wednesday starts somewhere over here. What do we have on Wednesday? So Wednesday, the day opens, still Asian session. We're not looking at the chart come 9 a.m. This is when we start looking at our pair around this time over here. What do we then have on our chart? So when we come, I almost said to work. So when we come to the charts on Tuesday, we already have this structure that we can isolate nice and beautifully because we are obviously trading, I guess, based off the days and whatever the case is. We also have some lower structure. Let's just delete this now anymore. That's not relevant. We also have some previous lower structure over here that we see the market creating equal lows at. What do we see? When we get down onto our lower time frames around almost just before London open, what do we see? We see prices breaking, violating lower structures, breaking back above our lower structures, and then we see prices kicking off our let's just get this tool over here, kicking off our previous area where prices broke below. So stops below our level of structure, targeting the same area that we are targeting previously on our initial trade. And I want you guys to see the difference in risk to reward ratio. So every time we scale in, we're obviously using less risk. So our initial trade was 1%. Every scale in after this, we'll be risking 0.5% just to be safe and not overdo things. But if you look at the risk to reward ratio on this trade, we're literally running 8.37%. So at 0.5% risk, that's 4% on our position. So we know that we'll run a total of 1:4 on this trade. Anyway, we leave structure. This is our trading day on Wednesday. That's it. We get into, let's see where Wednesday ends. There we go. So we get into Thursday. So we at Thursday opens somewhere over here. We wait until we get into I almost said into work again to the charts. Let's just move on like this just a little bit more. We wait until we get in front of the charts again. When we're at our charts at 9 o'clock, where are we? We are at resistance. So we know that we have a long-term bullish outlook on this pair and we're at resistance. What are we then doing? We are establishing our lows, looking to buy from support. So let's just put that back on over there. What we then have obviously is later on during the day we have, or we I guess get a nice tradable opportunity. What we see is prices, I'm just trying to get this drawing tool. So we have prices violating structure, pushing above structure, obviously giving us a retest of this previous support structure over there. Then we have something important. We have structure coming down, giving us a nice double bottom structure, and prices pushing back in, or rather pushing back above previous lower structures here on the 3-minute that were violated to the downside. What we then see is obviously a pinning this previous support structure over here, where that prices obviously broke below, and then we see this momentum shift to the upside. Obviously that's our reason for entry. So we then enter on this bullish engulfing candlestick on our lower time frame, stops above the structural lows, looking to target the exact same structural areas that we were looking to target initially, because we are swinging this trade over here. So I think we are somewhere over there, TP somewhere over there, and we are running 6.85% on this scale in opportunity. We then, guys, have another opportunity, and I'm honestly not even lying, this actually happened and we actually saw this, guys. So we then have this inverse head and shoulder structure completing over here. What we also have in addition to that is some structure over here. So we have our inverse head and shoulder structure. We're obviously looking to trade any continuations that do break out of our inverse head and shoulder structure. So we see prices pushing above structure. We have a red candle over here obviously showing us structure. So we have a nice break above structure, also giving us a sign of strength, and then we have that retest, at least 2 red candles to the downside, showing us rejections from our level of structure, and then momentum shift away from our level of structure. What we do is we enter our position at that right shoulder, or at that momentum shift. Where was that momentum shift? Over there. There we go. Stops below the right shoulder of our position over there. What am I doing? Let me just undo what I was just doing now. I think I just moved my charts. There we go. So obviously then our stop loss is below the right shoulder because we're trading that right shoulder, and then we target our final target areas up here. In addition to this, guys, I also just want to show you guys how we ended up managing this position. So we had some scale ins over there, some scale ins over there. So this is actually the fourth time we're scaling into this position at that break and that retest of previous, remember, higher time frame structure, guys. We had this double bottom structure. So this was our break, this was our retest. So also scaling in when we get into higher time frame structure. Sorry, I forgot to mention that when we looked at that structure initially. Then what we see is obviously higher time frame structure over there. So how we were then trailing our stop losses was identifying higher time frame structure. I think for this we can actually go up to the 15-minute because it's most relevant and most, I guess it stands out the most on a 15-minute. So after this, on the 15-minute, guys, what we then see is prices now beginning. So before, let's actually just mention this before what we noticed are lower structures being violated, and then we move to the upside. Even our initial entry, lower structures being violated. Now what's happening is different. We have lower structures being created, highs, lower structures being created, and these lower structures are being left open, obviously showing us ascending price action nature, because we have prices breaking above structural levels and breaking back below. What we then do straight after we see corrective price action towards the upside is we then lock in our trade below levels of structure, and we were obviously stopped out on this trade over here. But if you count all of the trades, we didn't end up hitting final take profits, but if you count all the scale ins that we took initially, all that closed at that stop level over there, because we obviously did trail our stop loss, guys, you will find that you obviously ran a trade of way more than 1:3. From our first position we got 2.38%, from our second position we got 6.4%, but obviously it's a scale in, so that's 3%. So 3 plus 2, that's 5%. There we go, another 2.2% over there, 6, 7, and then obviously 4% there, 8, 9. So guys, that is it. That's, I guess, just our scaling in. I'm kind of just moving things around and confusing myself because I'm moving things around. But anyway, guys, that is basically the concept of scaling in. We first of all needed to have an objective rule that obviously guides and helps us helps our process of I guess just scaling in itself, making sure that we're not scaling in on a position that has less than 1:3 risk to reward ratio. Then we went on to time frame thinking, understanding that there is a cycle that develops in every day. There has to be a low of the week, there has to be a high of the week, and then obviously understanding that there are daily candlesticks as well, and every single daily candlestick that does form has a cycle based off the individual sessions that lie within that daily candlestick. Every session comes with its own momentum. There are Asian traders, there are London traders, there are New York traders. Where's most of the volume during those three major trading sessions? Most of the volume is in London session and New York session. So that's why I'm only trading during those times where the momentum is on my side. I'm looking for those trading opportunities every single day at the same time, never missing it, because I'm always in front of the charts, knowing that I'm going to be trading AUD CAD every single day. If I do come to the markets or come on a particular day and the markets are not within my entry level, I sit on my hands and just let it be. I just let it be. Know that as long as I have a directional bias and I'm trading off higher time frame structure, if I do see setups that align in the direction that I'm looking to trade based off higher time frame structure, I can jump into those swinging opportunities, because I am trading higher time frame structure, and because I'm trading higher time frame structure will allow me to scale into my position as it makes its move to those higher time frame target objectives. So guys, that is it for our video today. We did speak a hell of a lot, and I hope that you guys did receive the value that was intended for you guys within this video. If you're not subscribed to the channel, definitely do subscribe, and otherwise drop this video a like if you enjoyed the content and received the value. This is T.Mayne. I will see you guys in the future videos. Thanks so much for watching till the end. Cheers.